Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello, and welcome to this episode of XYPN Radio. I am your host, Alan Moore, and I'm excited to have XYPN member Zach Teutsch, founder of Values Added Financial, on the show today. Zach spent the first part of his career working for labor unions and providing financial literacy and education through the Consumer Financial Protection Bureau. He decided he wanted to get back to doing one-on-one relationships and started his financial planning firm right about a year ago. Zach is very frank about his firm's niche, working with progressives, and isn't shy about his political views, areas of focus for giving back, advocacy, and more. He's been incredibly successful in his first year, starting year two with $250,000 in run rate revenue. He credits his niche and his willingness to say who he wants to work with as driving a lot of the growth. And his niche isn't just a tagline on his website, as his financial planning process deeply integrates impact and values-based investing conversations, charitable giving, advocacy efforts, and more. For advisors that believe you can't talk about politics in your marketing and with your clients, Zach is a great example that if it's important enough for you to incorporate, you absolutely can. NAPFA members, listen up. Supersize your NAPFA membership with all the perks from XY Planning Network. For starters, your annual NAPFA fee is covered by your XYPN membership. Plus, access XYPN's lead generation opportunities, including the popular Find an Advisor portal, blog syndication, national media request program, and more. Take advantage of free and discounted technology, an expert compliance team, E&O insurance, individualized coaching, and so much more. Visit xyplanningnetwork.com/supersize to download a special guide just for NAPFA members. You can find any of the additional resources that we mentioned during the episode at xyplanningnetwork.com/170. Also, be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN Radio listeners. It's the community of advisors we've all been looking for that's there to provide support when we need it the most. Best of all, it's free. I encourage you to check it out. Again, that's xyplanningnetwork.com/VIP. Without further ado, here's my interview with Zach. Hey, Zach, welcome to the show, man. Thanks so much for being on.
Oh, thanks, Alan. I'm so glad that you do these podcasts, and I've listened to a lot of them, and I'm really happy to be sharing my story.
You know, if you had told me 3 years ago, this month actually, that we would still be recording podcasts weekly 3 years later, I would have never launched the podcast. So it really is a wonderful, opportunity for me to learn about people and be able to share the stories. This is probably one of the longest relationships I've ever had is with the podcast. So I guess kicking things off, could you give listeners a bit of an overview on you and your practice, and then we'll dig into the details?
Absolutely. So my practice is called Values Added Financial. We're based in Washington, D.C., and somewhere between half and 2/3 of our clients are local here. We serve roughly 25 households on an ongoing basis, and then we serve 1 to 2 dozen other people with one-off sessions over the course of a year. I founded the firm just a little over a year ago, and now I have a colleague, Ari Weisbard, who's a part-time advisor. And we also use Tracy and Dan Kellermeyer, who do a wonderful job supporting our work. So that's the team. Our focus is on serving progressives. So not all of our clients are progressive, and that's okay. But it's an important part of who we are and what we do and how we talk about what we do. And it lets us get much deeper into a set of shared values and concerns.
Can you define progressive for me? Because that can mean different things to different people.
Absolutely. So Ari and I both came out of careers in public service. My first work was in the labor movement. So when I say progressive, I really mean sort of left to far left in terms of politics, although we carefully don't define it on the theory that we want people for whom that identity really resonates. There's a deep kind of debate that I doubt people are terribly interested in about what's the difference between a liberal and a progressive. And I find that it's mostly generational, honestly.
Okay. So when you say progressive, you really are talking politically, like tend to, be on the liberal side, at least for the US. It's always interesting to see the whole, we think right wing, left wing is really extreme until you look at other countries and realize our right aren't nearly as far apart as we think. But so your focus is really on working with folks that would consider themselves liberal or Democrat. Is that fair?
Yeah, no, that's exactly right. I mean, we don't have a specific test either. And we definitely serve some Republicans, and we're happy serving them and they're happy with us. Like anybody, we're a little bit flexible around the boundaries around our niche, but having that focus really helps us in a lot of ways that are really important in terms of thinking about our firm and focusing on what kinds of services to deliver. And that's who we have in mind as we sort of built our service offerings.
I'm going to dig into that here in a bit, because putting politics front and center is not what we are taught to do, which is fun. So definitely want to chat more about that. So just tell me a little bit about your career path. Sort of how did you end up launching Values Added? Where did your career sort of kick off at?
Sure. So I started in the labor movement. Actually, I worked for the Service Employees International Union, which is one of the largest unions in the US. And I worked in a part of that union that was really focused on protecting members' retirement security. So at the time that I was doing it, SEIU members were in pension plans that were worth about $1.5 trillion. Some really big pensions with really major assets. So we had a group of people that really thought about institutional investment in serious ways. And so that's what I was doing. And I did it for a few years. And then eventually my mentor in the labor movement, who was at a different union, wasn't my mentor yet, found me and said, look, we really want to start doing financial education for union members. He had figured out how to get a grant from the FINRA Investor Education Foundation, because most of what they were doing was like putting ads on buses to try to get people to come to seminars. And
oh man, that's highly ineffective.
Yeah, exactly. That's right. So what my boss figured out was that organized labor can really organize people, and we could reach a lot more people much more effectively in a much more focused way and do much more cost-effective financial education. So we got some money from FINRA to do it. He hired me. I coordinated the sort of first of its kind national financial skills and investor education programs for union members. We ended up over the next many years reaching hundreds of thousands of people. Eventually, we scaled it up to include dozens of different unions. For a while, I was on the faculty of the National Labor College. And then eventually, I moved over to the Consumer Financial Protection Bureau, which is what just about everybody who cared about doing innovative, consumer-friendly things was doing at that time, or sort of outside advocacy work. And I was at the CFPB for almost 4 years. And that was an incredible experience. And we were able to do some tremendously innovative and interesting things. And then I was working on a project that was an even bigger financial education project that by the time I left was reaching about 1 million people a year.
Wow, that's huge. So was that just like in-person financial, doing workshops, or is it online? Sort of what was the format?
Yeah, so when I started out, a big part of what I would do would be go to conferences and conventions and union locals and plants and stuff and actually talk face to face with people about their problems. And I learned a lot because I probably did about 50 in-person teaching sessions a year. And then eventually I got promoted. And by the end, when I was training people who taught people who were out in the field. And I really missed actually working with people. And what we were doing at the Consumer Financial Protection Bureau is we realized that there are a huge number of people in the front lines of social service. So for instance, social workers, where people come in with problems that are financial in nature, but those social workers and other social service professionals aren't financial experts. And they need tools to help them help people more effectively. So what we did is we built a fairly substantive toolkit, and we trained people all around the country who see clients with financial difficulties to help them figure out what tools can help those people. Because we weren't going to figure out how to make all of America's social workers financial experts, but we could figure out how to help them start conversations and give resources over. And we found that was a very effective technique. So that's what I was doing when the administrations changed. And then there was a sort of major pivot in focus, and I wasn't going to be able to do quite the innovative kind of work that I had really enjoyed. But starting very early, when I was working in the labor movement, when I started doing financial education, friends and family members started asking me for advice. And I found I loved helping them. And pretty soon I, had more cases of beer than I knew what to do with. And people were referring me to their friends who I didn't know. And at that point, I realized I needed to create a little bit more structure to that, what was a financial coaching practice. But then when I was at the CFPB, for a variety of conflicts reasons, I couldn't actually register an RIA. So when it was clear that the work where my heart really was in the financial management and coaching work, I left the CFPB and I filed as an RIA, and that's when I formed Values Added Financial.
So extensive experience in really financial literacy, financial education, but this, starting the firm was really, the first time you were doing what I guess we call financial planning or comprehensive financial planning, especially for the types of clients that you're working with. How do you feel like your previous experience in learning how to educate, and having like a really heavy education background contributed to, sort of your success and process as an advisor?
Yeah, well, so for a long time, I did financial coaching. And I think that really helped me learn to listen to people and understand what was really going on and what were the hurdles that people wanted to overcome.
Sure.
I think it's really easy. Once you switch to doing investment work, you run into when you have a hammer, everything looks like a nail problem. So I think doing a lot of work before I actually managed investments for people really helped me learn to listen and not assume that their financial questions and concerns and things that were keeping them up at night were things that we could easily fix by just changing their asset allocation.
That makes sense.
I mean, it really helped me focus on learning the behavioral tool set. And it also means that I really enjoy speaking. So a big part of the pro bono work I do in my practice is actually going out and continuing to speak and do group education. So, in the last few months, I did one session helping young people of color and another one helping for people who were the first in their families to go graduate college. I did another one for young public interest lawyers. So I do a lot of that kind of work. And part of it is because I'm just very comfortable teaching because I've done it for a long time. And I think actually we're probably going to scale up a group education model that's not pro bono, that's actually a revenue generator. But that's still early in the pipeline.
Yeah, I'll be interested to hear more about that once you get going with it, because it's definitely an area I hear from advisors that are looking to try to ramp up, group work. Because ultimately, we believe the model of doing financial planning on a monthly subscription or charging project fees and that sort of thing has really opened up the number of consumers that you can work with. Only 5 to 7% of Americans have $500,000 or more in investable assets. So, we believe that the XYPN sort of model of doing things has expanded, we'll say, to the top 50% of income earners, but the below 50% median income still can't afford financial planning. And group format really seems to be the untapped opportunity that advisors are still working through how to do that. So it'll be interesting to see if you find an effective model that gets people to sign up and come talk about money in a group of strangers.
I think that's exactly right. Those stats exactly match up with my experience, which is I can currently profitably serve plenty and enough people that my practice is full with market rate clients who I really enjoy working with. The group project approach is really just because I care about helping more people. And I want to just make sure that we can continue to reach people all up and down, the sort of distribution of assets and income. We don't want to just be only a firm that helps very wealthy people. So we want to figure out some mechanisms that make sense.
Yeah, I'm interested, and I don't know if this resonates, but I mean, do you find ever any conflict in the fact that your firm is working with progressives, and that's really your focus, but you tend to end up working with high net worth or high income folks? Is there any type of, tension between the clients that you serve and sort of belief system and the business that you're trying to build, or do you feel like it flows really well?
Well, I'm really appreciative that my clients really love the work that we do out in the world too. So for instance, I suspect mine is the only firm where 100% of advisors have been involved in running a campaign to raise taxes. Like several years ago, Ari and I both led a campaign to try to get a fairer tax system in DC. You hit the highest marginal tax rate in DC at $40,000 of income, which was bizarre. So we actually helped introduce an additional tax bracket. So that's the kind of work that I think is really important, because I think with a situation where we have stagnant wages and increasing income inequality, that really is bad. It's a real problem for us as a country. So thankfully, when we get out there and take issue in those kind of progressive ways, our clients tend to love it, So I think if we were a conventional firm, a lot of clients would be really irritated, but mostly our clients say, oh yeah, income inequality is a terrible problem. I'm so glad that you guys are working on it. So it ends up not being much of a conflict, partly because of the niche we chose.
So when you were starting the firm and sort of the background that you had, how did you get the education in terms of sort of how to do comprehensive financial planning? Did you sort of learn it on your own? Did you go through the CFP education?
Yeah, I've mostly learned on my own. I'm a deeply curious person and have read really broadly. And there are certain areas where I don't have as deep expertise as I think would be useful. For instance, especially on estate planning tools, the crits and cruts we often joke about, which actually comes up in our work because our clients are so charitable. So thankfully, when I chose my first colleague
to know these things.
Yeah, it actually matters. We work on charitable remainder trusts fairly often. Like, it happens not infrequently because we work with many people in tech that they're way over concentrated in whatever firm they worked at when their options became very valuable. And sometimes they get RSUs or something else that leaves them with equity, or they invested on the side. So, if you have $1 million worth of Apple stock or something like that, it's pretty easy to end up in that situation if you were an aggressive investor, because you only would have had to put in $50,000 or $100,000 if you did it, 10 years ago. So we have to figure out how to help people diversify, and actually charitable remainder trusts are sometimes a good solution. So that stuff comes up. So thankfully, my colleague Ari also does estate law work. He runs a law practice separately that does estate law. So, we have a lot of in-house expertise. So the things that I'm not deeply expert in, I'm lucky to have colleagues that really know well.
Makes sense. Surround yourself with the right people. So you started the business about a year ago. What was sort of the initial plan in terms of, how you were going to get those initial clients? Did you just feel like you had enough friends and family you'd already worked with and, that they would sign up? And then I guess the question is, did they sign up? How did those first few months go?
Yeah. So I had a multi-step plan where I was going to do outreach and tell everybody about the new model and announce it. And a wonderful thing happened, which is that I had to sort of break off my outreach plan because there were enough people that were interested. So, by now we're a year in and our quarterly revenue is somewhere in the neighborhood of 65,000. So we're already in
quarterly revenue is 65. So that's annual of 250-ish thousand.
Yeah, a little more. But, since we're still adding clients, it's a little hard. By the time, I would be surprised if we have less revenue than 300 in 2019. Things have been really good. We feel really fortunate. And a big part of what's going on is that we serve a niche that almost nobody else is interested in. And there's a lot of people who feel so appreciative, because for many, many of our clients, they're deeply skeptical of the financial services industry. I would argue correctly. A big part of why XYPN is successful is because it's answering a similar sort of question, which is, how can people trust an industry that over 90% of people are salespeople? And it's really hard to know who's who. So I think a big part of why we succeed is not just that we have expertise, which is especially relevant to our clients. It's also the fact that they understand our politics and know our backgrounds well makes us trustworthy to them in a way that most financial services people aren't.
So talk to me about your fee model, because you said 25 client households ongoing, but you have a couple dozen, where you're doing the one-time plans. So 250,000 revenue. So are you really coming in around that, sort of 10,000 revenue per client?
Yeah. And We are. And a big part of that is because we're unusually comprehensive in our focus. So we do a lot more for our clients than just about any other firm I'm familiar with. So, for instance, we do all the stuff that one would expect a capable firm would do around investments and student loan management and college savings and those kinds of things. And then we also do tax planning, which tends to be very high leverage, especially for our clients who are small business owners. Then we also help people manage careers and think about how to manage job searches well and think about how to negotiate raises and salaries and that kind of thing, and whether they're happy at work and what they can do to be happier. We also help people think about charitable work. So how much should they give away? How should they do it? How can they do that in a tax advantageous way? How can they do that in a high impact way? We also help people think about cash flow, but we especially focus it on thinking about what people's big picture goals are and what does a fulfilling life look like for them, and does their spending match up with what they think their drivers of fulfillment are. So we think of it as happiness maximizing, and I find that works much better with clients. Anyway, so we do that. And then we work to fill in whatever. Oh, and also insurance. So we help people with the full range of insurance, although mostly we don't actually underwrite insurance because we're fee only. So we usually work with LLIS on that kind of thing. So those are the sort of big areas. And then when clients have other things that come up that don't fit, we're really curious and we do a lot of work to help them figure it out. So when a client comes to us and says, I'm a broadcast journalist, and because of that, I have a really hard time getting an umbrella insurance policy. What do I do? That's the kind of thing we look into. Or I recently had a client who was interested in learning about opportunity funds. The regulations haven't been released on opportunity funds yet. So it was a really fascinating challenge to try to figure out how that will work and how it would fit into the situation. So depending on the circumstances, we work with clients in probably 15 to 20 different areas, and we can't work on all of those in any given year. So we usually start our process with a kickoff meeting where we help prioritize our areas of focus and figure out what 5 or 6 things we're going to fit into year one, and then how many things will fit into subsequent years.
So what is your fee structure? So new client comes in the door. How do you determine the fee that they'll be paying?
Yeah, so we're members of the Alliance of Comprehensive Planners. So we use the ACP calculation tool, and then we hacked it a little bit. So the main components there are complexity, income, and assets. And then we look at that and see if it seems broadly reasonable. And then under certain circumstances, if it's, friends or family, we might discount it from there. And so we also try really hard to make sure that we're offering vastly more value than what we're collecting in fees. And I'm proud to say that in every client engagement that we've been in, we've delivered way more value than what we've ever collected in fees.
Yeah, I want to go ahead and head off the compliance question I'm going to get via email after this. And that is, Alan, my regulator says I can't do that, type of fee model. And you are correct. Many states do not allow that fee model. Some do, just because it all depends on your state on whether or not they allow complexity-based retainers and whether or not they have to be, whether they can be a little more fluid or whether or not they have to be a little more stringent. So I just want to answer that for some folks who have talked to your regulator, and they, some states don't allow income-based calculations, some don't allow net worth-based, some don't allow different things. So just talk with your compliance expert on what your state allows.
Yeah, I think it's also worth noting just on that we actually have a checklist that we use on the back end to assess complexity. Like, is this somebody who itemizes their taxes? Are they a small business owner? We have a set of things we look for. It's not just this amorphous, how do we feel about it? So the fact that we're fairly exacting in how we think about it, I suspect helps regulators be comfortable that it's a fair system.
Sure. No, that makes sense. So is your typical fee sort of in that $10,000 a year range, or is there a pretty big range because you have a few big clients?
Yeah, it's a pretty big range. So I took a look at the numbers in advance of our call, and our average fee, the mean is $10,400, but the median is $8,000. So, that sort of demonstrates that there are some upper outliers. So we have several clients who are fairly wealthy and we deliver a huge amount of value for. So, we we charge them. Actually, it's probably less as a percentage, but it's more in absolute dollars.
Right. No, that makes sense. So looking back at your first 12 months, I mean, 12 months in now, you have over 250,000 of ongoing revenue. But what was your actual income for your first 12 months?
Let's see. I have it broken out by calendar year. So it's a little strange because I only really generated revenue in the fourth quarter of 2017. So in 2017, I generated about $20,000 in revenue and had $15,000, $18,000 in expenses. So 2017, I ran very narrowly in the black, but that meant that a lot of my startup costs were in that year,
right,
even though not a lot of revenue was.
Yep.
So let's see, by the current year, I suspect, I have these notes here somewhere. I suspect our income is going to come in around 240 or something like that, of which about 5% is non-comprehensive clients, so non-recurring clients. And then it's a little hard to say exactly what our expenses are, but I would guess they'll be somewhere in the neighborhood of 80 or 90. And they're a bit higher because we have a fairly substantial labor cost because I have a colleague already. Well, actually, 4 colleagues, but one of them working a lot more hours at a higher rate.
So that is pretty astronomical growth in terms of revenue. So where are these clients finding you? Because you mentioned, I mean, you felt fortunate that you're having this flow of clients, but like, how are these folks finding you? And particularly, these are clients that have wealth or have pretty good income because they're paying, a fairly substantial fee. These are not, $50 a month clients. So what from a marketing perspective has worked so well in your first 12 months?
Yeah, well, I think the first thing is having a differentiated perspective. So there really are very, very few people doing what we're doing. We don't really have competitors in a meaningful way. There are a couple other small part-time firms I'm familiar with. Then there are some bigger socially responsible investment firms, but very few firms have people who have a serious activist background. So for folks who that's what they're looking for, when they find us, it's extremely satisfying for them and they tell their friends. And there are plenty of people who didn't set out to be wealthy, but ended up, being more successful than they thought in one way or another. So many clients come to us via referral from existing or other clients. Some people come through our networks. We do a fair amount of public service work that's almost exclusively uncompensated. We're very active in our communities, so people know about us and find us that way. There was one very kind article in a neighborhood blog. So when I launched the firm, I put up a post on Facebook, and a guy who runs a local blog and is a tremendous guy. He knew me from the work I did. I was at the time the chairperson at the Advisory Neighborhood Commission, which is this funny micro-local, unpaid DC government elected position. And I did it because I just really liked caring about the neighborhood and helping it thrive and advocating for affordable housing and helping think about zoning or whatever. I mean, I didn't do it for any business reason at all, but it meant that I knew the neighborhood blogger pretty well. And when I launched, he saw the announcement that I put up on Facebook, and he asked if he could run a piece about it. And I said, of course. And it was a very kind piece, and it meant that we got a lot of interest right in our neighborhood.
So it sounds like, don't let me put words in your mouth, but it sounds like you're really crediting the niche that you have with a lot of the early success in terms of getting some of those initial clients, because you've really put out there who you work with and who you want to work with and the types of clients you want to work with. And that has really helped.
I think that's right. And it also, we have many people, doctors and lawyers and folks who are in professionally based niches, that are targeted for that reason. But I think a big part of why it worked is exactly like you were saying. We're really clear about who we are, and we're really clear about how we're different. And I'm sure that turns many people off, but that's fine. They don't reach out to us, and we have a wait list, in the sense that marketing is about, I think when it's done well, it's truly authentic. And a big reason why our business works is because we genuinely care about progressive issues. The people who work here have progressive public service backgrounds. We have really clear values. We work on them. We're publicly committed to them. We tithe. Actually, our business directly supports Project Muso, which is well, I should say my portion of the revenue of the business supports Project Musso in part, which is this really cool organization that reduces infant mortality and other medical challenges in Mali. We really care about the things we care about. And we're not in this to be the most profitable, fastest growing firm. We're in it because we really love serving our clients, and we love being able to help people who have, values which match up, and people who are caring and want to be active and helpful in their communities just like we are in ours. And I think us being really clear and really passionate about who we are in the world helps people trust us and see that we do great work. And then we do great work for clients and they tell their friends.
So typically, I will say, just based on some of the data that we've seen, niche focused firms tend to take a little longer to get ramped up, because we see that the niche works long term, and in the first 12 months, many times they may make the same or a little bit less revenue than non-niche firms, but they really get the ball, that snowball rolling down the hill, and it picks up speed. So one of two things: either one, you've broken the mold, or two, you're growing slower than maybe your first 12 months was actually slower than it could have been had you, with all of your connections, sort of put yourself out there as working with everybody. But the snowball is going to start rolling really fast, which should be exciting and terrifying for the next couple of years for you. So I don't know which side of that coin you're on, but either way, I've had a ton of success, and it's awesome to see that. A lot of times when we talk about niche, we get caught up talking about doctors, lawyers, accountants. Like we think profession, but values and, sort of the softer side of things is huge, because and I want to hear more about this, but I assume your planning process is very different because of the approach and the focus of working with progressives, which is, again, a differentiator. So can you tell me how your process, I guess, in some of the more defined areas, do you feel like is different than other planning firms, and how that applies to your niche market?
Yeah, well, I think that's a great question. And it's almost always different in two ways. And then there's other differences that come up based on client-specific needs. So one difference is that we always include charitable impact and charitable giving management as service areas that we offer. And since we have a comprehensive retainer, it doesn't cost any extra. And actually, that's one of the reasons why I like the comprehensive model better, because it's hard for people to want to spend a few $100s an hour to have somebody talk to them about charitable giving. But if it's free, people love it. The mind works differently when something is free.
Yeah.
So our clients are thrilled that we do this for them for the most part. So that's one key difference. And the other is we also, depending on client's interest level, we do a surface level or an extremely deep dive with them into investment ethics and thinking about socially responsible investment. And that is a really, really complex and hard question, because the answer isn't just people should use socially responsible or what are marketed as socially responsible investments, or that they shouldn't. It really depends on exactly what somebody's trying to accomplish. So would it be interesting, you think, if I gave an example about how we sometimes frame that question for clients?
I'd love to, because this is an area I want to dig into, because socially responsible investing is such a challenge, because what is impact to one person is not an impact to someone else. And so how do you determine what's actually important? And then two, how do you actually, implement that and integrate that into their financial plan and investment philosophy?
Yeah, exactly. So the big picture problem is that there are a wide variety of things that are marketed either as ESG, which stands for environment, sustainability, and governance oriented funds, or SRI funds, socially responsible investment funds. And like conventional funds, most of them have very high fees, which tremendously erode performance.
Sure.
So the first example I usually start with is, imagine that you're deciding how to invest your 401k, and your choice is either the most popular by capitalization socially responsible investment fund, which is the Parnassus Core Equity Fund, or let's say you have the Fidelity Zero option, just because the math will be easier if we have 0 basis points. And that's a new thing that people are often excited about and talking about. So if you put about $1,000 a month for 30 years and you invest it and the Parnassus Core Equity Investor Fund achieves its benchmark minus its expense ratio, which is what the efficient market hypothesis would estimate would happen, that consumer, or that client, I should say, would end 30 years with about $1.25 million. If instead they invested in the Fidelity Zero Fund, which had no expense ratio, and it achieved the benchmark performance, instead of $1.25 million, that person would end up with just a shade under $1.5 million. And that's putting $1,000 away a month, which is, somewhat more than the average person can afford, but not atypical for our clients. And in fact, if you look at maxing out, the numbers go up. But the point is, in the example I offered, the difference is about $250,000. And so the ethics question is, what did more good in the world? Investing in the Parnassus Core Equity Fund, or investing in Fidelity Zero, and then at the end of 30 years, giving away $250,000. That's a sort of traditional way to think about this. And I think it is very hard to maintain the case that investing in the Parnassus Core Equity Fund would outperform on a justice basis versus investing in a broad market index and then donating $250,000 to whatever organization in the world you think is doing the most good.
So just so I'm clear, so you're more of a fan of donate the money versus the longer term investing in that particular fund?
Well, I should say that's what I do personally, but I don't think that that's right for all clients. Some clients are of the view that they will feel icky about investing in companies that do bad things in the world. The problem is, if you dig too deep there, you'll have a hard time finding companies that don't do any things that you dislike. So like the biggest holding for a lot of these firms these days are Amazon or Apple. And increasingly, I have clients who have real concerns about Apple's labor issues in Asia, especially in Foxconn historically, and people are really concerned about what's happening at Amazon warehouses. It's not like even companies that generally do very good things are above reproach. So that's one problem. And then the other is that generally speaking, progressives have a strong tendency to see boycotts as a thing that's helpful. We think about the Montgomery bus boycotts with Dr. King, or the great boycotts led by Cesar Chavez and the United Farm Workers. And those things had a really powerful impact. The thing is, as you know, but most clients haven't thought that much about, the stock market is a secondary market. Exxon is going to pay the same amount of dividends no matter who holds the shares. It's not like Chick-fil-A, where if people are upset about their approach to same-sex marriage and they don't buy chicken sandwiches, Chick-fil-A makes less money. Exxon doesn't make less money if you don't buy their stock.
Right. They don't own the stock. It's already been issued.
It's long since been issued, So I think that's a really important thing for people to think about, because a basic way that we tend to think about the economy in general that applies to consumption doesn't also apply to investing. It's actually a fundamentally different thing from a moral standpoint. But that doesn't change how people feel about it. People feel icky if they're worried about climate change and own Exxon. Even though it doesn't change how much gas comes out of the ground, I have clients who feel that they just don't want any engagement in it. And they have a personal sort of spiritual or moral view that they don't want it. So we help them figure out how to think about that. Then, we have different approaches for them. So we want to have that conversation. But I think almost all firms are either, we do SRI or we don't do SRI, but they don't have the sort of depth of analytical and behavioral and tools and the interest that we have in helping our clients really think seriously about it and figuring out what makes sense for them. Because you actually have to know a lot about the social impact questions and the structure of the economy questions and the investment questions to be able to have that conversation. So it makes sense that we develop those both in our work beforehand, given our niche. But, that's not going to make sense for every firm.
Yeah, that was going to be my next question, because it is one thing to really understand what's important to your client. It's another thing to actually implement SRI in this day and age with our technology where it's at. So how are you building portfolios? I mean, are you filtering through for, again, the client says, their big focus is on environmental or climate change. And, so you're going through and saying, okay, these are the 10 or 20 or 50 most polluting, companies in the world. So we're going to exclude them. Like, are you going down to the stock level? Are you doing the mutual fund level? Like, how are you doing that?
Yeah. So the vast majority of our clients are in broad market indexes because our view, which is based on the research, is that that's how we'll generate the best returns on a risk-adjusted basis. So, we buy into modern portfolio theory. So we use it with all our clients, and people who want certain items eliminated, the most common one is fossil fuels because of climate change. And luckily, there are somewhat more expensive index funds that have fossil screens on them. So, there's a very interesting sort of CFA type question about to what extent that's going to increase the variance in the portfolio and whether you're correctly or not correctly compensated for that risk. But for a lot of those clients, that takes them from feeling from feeling fundamentally uncomfortable and wanting to keep money in a money market to feeling comfortable with investment. So it's not really fair to sort of compare between a standard benchmark index and a fossil-free index. And it's pretty clear to me that a fossil-free index will almost invariably over a long period of time dominate a money market fund.
Right. Yeah, it's so, and I just keep waiting for the technology to catch up, and I'm sure it will. Like I said, it is also just so difficult. Like if you're if you want to take a stand against guns and gun laws in this country, can you buy Walmart stock or not? It's like, are you, just because it's your, the primary value that you're really looking at from an impact perspective, like how far do you go? Because if you cut out every company connected to guns, like you're going to have like 5 companies left, right? Like it's just so hard to know. Like,
yeah. And then what happens if you cut out every company where an NRA person sits on the board? And how about firms that serve with those people? It's very hard to figure out where you bracket the end. And it's fundamentally hard. Although I will say there's at least a couple of interesting, innovative ETFs that I hope will be soon coming to market that actually reinvest a fair amount of their fee revenue into campaigns which really have the potential to make a difference. And one of them actually started with a gun campaign. And I think that ETF will in the future be called Majority Shares. So keep a lookout. And I think that it's possible that one could imagine a world where the premium that you were paying for the SRI firm was actually meaningfully helping make change in the world at a greater rate than you could generate by just giving to the, somebody doing cancer research, or for your example about guns, a company that was working to enact common sense gun safety measures. Maybe that's just this is actually a good example because I spent a fair amount of time working with clients who work on this kind of stuff and having friends who work on it. I didn't say gun control. I said common sense gun safety. And that's exactly how the people who are around the polling on that talk about it. And it's how the advocacy organizations talk about it. And part of why I'm effective in my niche is because I know that kind of stuff.
Right. No, that it is amazing. I mean, language matters, right?
There's subtle cues.
Yeah. So hopefully, like I said, some of the ETFs and just some of the technology and just overall filtering and information that we have access to and all of that will start to just make it a little easier. Because like I said, I think just having the conversation with clients, whether you do any level of implementation in the portfolio, just having the conversation with clients is huge, right? And that's a big first step to really understand not only how where they want to be putting their investment dollars, but really their money in general and their time. Right. Money, talent, or time, talent, and treasures, right? Where do we want to focus those?
I was just going to say one other thing about the prior point, which is I think it's really important that our firm, other ACP firms, other XYPN firms tend to be comprehensive planners, which means we can solve a problem with any of our tools versus most of the incumbent folks who do this and work on AUM and our investment only have real limits. So I think it's not surprising that the industry as a whole over-relies on ESG and SRI funds to solve the problem of how do I have social impact in my financial life? Because their job, since they're only doing investments, the only way they can solve the problem is with an investment solution. But because we're comprehensive, we can look at it carefully and do the analysis I did earlier and say, actually, you could have a higher impact with charitable giving. And if you do it this way, there's this set of tax advantages. So it's really, because we have reduced conflict, we can actually have better outcomes for our clients.
Yeah, that sort of segues into what I was thinking about for the next question, which is just, having an impact on the world is a comprehensive financial planning question. To your point, it's not just investments and aligning investments to match values. I had someone the other day say investing in companies that you believe in or that are in alignment with your values, that's value alignment. Impact investing is investing and putting your money and time in a place where those companies are actually making a difference, which may not mean investing in big companies. It may be looking at microfinancing loans to farmers in India or whatever. That there's so many ways to think about this. So I guess what are other ways, in the comprehensive planning process that you're working with clients around them having an impact on the world in addition to just the investment side?
Yeah, that's a great set of questions. So we talked about the investment piece. Another big area, which is really important, is helping people figure out how much money to give away, how to give it away, and where to give it. And we have that conversation at some point with nearly every one of our comprehensive clients. And it's a really interesting conversation. There's some technical financial planning aspects about this, which is many people, when they come to us, are giving significant amounts of money away every year by check or by credit card, even though they have appreciated securities and brokerage accounts of one sort or another. So as you probably know, and many of the folks listening may probably know when they stop to think about it, but don't realize how common this is, a much better strategy than doing that is opening up a donor advised fund, donating appreciated securities, and then distributing them from the donor advised fund. And you can save all the capital gains taxes. You don't pay them, the charity doesn't pay them. So, and that's a really powerful tool. And actually, because of that, we're starting to explore whether at some point we're going to switch to doing direct indexing. We're hoping the prices will come down some on that.
Direct indexing with donor advised funds or separate from that?
No, direct indexing in the first place, because the higher the variance, the better. If this is a big part of your strategy, because, conventionally people know how to tax loss harvest the losers. But if you're very charitable, having really highly concentrated winners helps you save a lot more money on your taxes, right? Because when you're trying to figure out what to donate, you're usually best off donating the highest, most appreciated thing. And then if you actually want that thing to stay in your portfolio, no problem. You can buy back at the current market rate because there's no wash rule when you're donating. The wash rule only applies under other circumstances. So if you donate it, you can buy right back in. And then effectively what you've done is reset your tax basis to what it's appreciated to, which is a huge tax savings. And this is the kind of stuff that we think about a lot because it's relevant to our niche, is how does tax planning interface with investing and interface with charitable giving? So, we've got clients who are more affiliated with the school of thought of effective altruism. We've got people who are more interested in building activist movements and some of the stuff that resource generation does. We've got people who are influenced by both things. We have people who are influenced by neither of those and just want to learn more about it and think more about it. We also help people think about how to align their own work with their values. We help people think about how to be effective with their time in their communities, if that's something they want to talk about. But we want to think really holistically with people about what it takes for them to be living a fulfilling life. And a lot of that is financial, and we have a lot of financial tools, but we also help people think about non-financial aspects of what it takes to live a fulfilling life. And we help people touch base and think periodically about whether their decisions are lining up with what their vision really is.
Yeah, it really is a rabbit hole in a way, because you really can go really deep here and honestly just never stop with clients. So how do you figure out how far to take these conversations and this type of work around donating certain stock and rebuying? And there's so much time that can be spent there. So how do you limit it and actually put guardrails up so that you're not doing too much?
Yeah, that's a good question, I think, because given the number of areas that we work in and the number of people we work in, it could be fundamentally multiplying in a way that would mean that I couldn't achieve some of my own fulfillment goals. Making sure I had enough time to do pro bono work, enough time to do community work, enough time to be an active, engaged dad. I just had a second kid, and it's important to me that I can drop my daughter off at school and pick her up every day. So figuring out how to set boundaries is really helpful. The main way we do it is we don't try to cram everything into the first year that we work with people. I find that clients really like knowing there's a plan and they want to know that they're going to get to an item. But for instance, if we're working with a client who doesn't have kids yet, we might be comfortable waiting until year 2 or year 3 to talk about life insurance. We don't need to rush that conversation. So we often try to make sure that we have the highest leverage conversations, the one that can do the most positive impact for clients first. And we want to make sure that we get to everything eventually, but it doesn't always have to be the first month or even the first year.
So talk me through how you end up, I guess, structuring that. So it sounds like you're not always covering insurance review Q1 for your clients. So how do you sit down and actually say, okay, here's the list of things and here's the order in which we're going to cover them over the coming years?
Yeah, so we've been iterating this. We've hit on an approach which works pretty well, which is I've written all the areas where we work down on the back of a business card. We're working with Ashley Lawson now, so hopefully she'll gin us up something that's prettier than my handwriting. But so I've got a deck of 20 cards or so. Then I put out categories: year 1, year 2, year 3, at some point TBD, and non-applicable. And we go through and we put the cards right on the table if we're in person, and we shuffle them around and we say, we don't have quite enough in year 2, or usually what happens is we have too much in year 1 and we have to think about what we can
right.
move to an out year. And then we also want to save some space because often things come up that are unexpected. Somebody was not planning to buy a house and then they are. And one way that we add a lot of value to clients is helping them think about how to engage with realtors or how to negotiate a mortgage and how to engage with multiple lenders. The last 3 people we helped with that, their average savings was $100,000 over the course of a 30-year mortgage. Like, that's really high leverage stuff. So we want to do it, but we just don't know when that's going to happen. So we put it in the sometime category. Then we get everything out. And eventually, and then when somebody's remote, we do it via Trello.
Oh, nice. That's a cool way to do it.
Yeah, it's really easy. You just have a board that has a list for each one of those categories and then cards for each subject, and you can just snap them across.
So you mentioned earlier that, very briefly about, wanting to be able to spend time with family as part of your own goals. So can you talk to me, as an entrepreneur, it's really easy to just dive in and spend 80 hours a week working and grind away trying to build the business. But just talk to me a little bit about how you are prioritizing or trying to prioritize, we'll say self-care, taking care of yourself and being sure you're spending time in the way that's important to you, not just in the business.
Oh man, Alan, I'm so glad that you asked about that because I think it's really important. Earlier, you framed the idea of guardrails, and I think that's a really helpful one. So I have daily guardrails and I have weekly guardrails. So daily, I know that I have to drop my daughter off at school. We usually leave the house, between 8 and 8:15. So I don't take a morning meeting before 8:45. And sometimes, some clients would really like to meet at 8, and that's just not going to happen. And likewise, I pick my daughter up at 5:45. So I finish every meeting without fail. Well, not without fail. I try to finish them by 5:30. Sometimes they go to 5:40. Sometimes they go to 5:45. It's kind of awkward when I really have to walk out if it's a great moment.
Right.
But, my clients know that. And I think ultimately, they really appreciate that. And because it's not only is it what I want to do, but because of my niche, it's really on brand to be a serious dad. So I would do it whether it was on brand or off brand. And I just feel really appreciative that my clients are really supportive. They're very, when I went on parental leave, people were very happy to know when that was going to happen and move meetings up or move meetings back a little bit or meet with my colleague Ari, who's excellent, and nobody was at all upset about it, which makes it easier. The other thing is I schedule client meetings by default just on Tuesday, Wednesday, and Thursday. So we do internal work on Monday and Friday, which helps because I think if I took client meetings every day. I would have a lot of pressure to do the follow-up work after hours.
Right.
So by having a time in my schedule for that overflow work to happen every week, it puts less pressure on the rest of the time. And quite reasonably, a lot of clients want to meet in the evening or on weekends. And we just don't. We drew a line. We know some other firms locally who are great firms who will do evening or weekend work. And if that's a must for the client, they're going to find a different firm because we decided it was not negotiable for us. Because both of the advisors in our firm, want to be our serious equal parents. So it wasn't going to work for us. Now, that helps with the client-facing work, but and we lost clients over it, and that's okay. That's how you really believe something, is whether you're willing to lose business over it, I think, in our line of work.
Yeah.
And it's okay because our business is thriving, and I'm glad that I'm in a position where we can hold the line on that kind of thing. And it's gotten easier, honestly, over time. I just, dentists and doctors don't meet with you at 8 p.m. People
Right.
figure out how to make it work. So that's a big part of how I've held the line. But honestly, I find this stuff enormously interesting. And part of why I love the work I do is because I love working in the business and I love working on the business. And checking my email isn't a chore. When something comes in, I'm really interested in it. I want to know what that's all about. So, I probably check my email more than would be optimal. And I've had to be pretty careful to not start working on an idea in the evening after I've put one or both of our kids to bed because, I get too fired up and then it's hard to sleep. Like, that's bad. I've just had to learn that one. But, like anything else, it takes discipline and having good habits.
Yeah, that's usually when you end up like up all night scribbling ideas. I'm guilty of the same. I'm also guilty of sometimes I just have to write something down, even if it's just a quick note, just to get it out of my brain.
Yep.
To make it stop, and then come back to it later. Exactly.
Yep. No, I have like a 50-page, financial action, business action plan or something. So whenever, I've really loved writing, and I haven't had very much time because our client growth has been so fast. So, I just have a lengthening list of all the things to write on. But it's nice that they're down someplace because then I feel like I haven't lost them.
Right. Can go back and see and be like, wow, that was a really dumb idea. It's usually how most of mine end up being. So as we're coming to a close, sort of looking back over, the 12 months in business and thinking about the advisors that are maybe approaching, thinking about launching the firm or in that first year grind, what's one piece of advice that you would go back and give or that you would give those advisors based on sort of your learnings over the last, year and a half?
Yeah. Well, I really enjoyed the advice that I've heard from a lot of other advisors that they wish they'd started sooner. I think that's probably right. For me, I think my big takeaway is everybody says don't talk about politics, sex, or religion in business.
Absolutely.
I'd say go for it. That, you're going to find people who really trust you more and respect your work and who you connect with in a different way if, they learn that politics and religion are important to you and you care about making the world better in a particular set of ways. And if they do too, you're going to have a connection that you couldn't achieve any other way. And that's meaningful and it's important. And some people are going to be turned off, and that's fine. But I think the more deeply and authentically an advisor can be themselves, if that stuff's important to them, that should be part of how they define their work. And I think a huge amount of why we've been successful, or why I've been successful at values added, I should say, is because we genuinely care about progressive issues. It's in my background. It's in how we design the firm. It's in who we serve. It's in how we serve them. And I don't think we have been nearly as successful if we hadn't been serious about our values and led with them. So, I think for advisors for whom their values are important to them, that should be part of their business.
Yeah, I couldn't agree more. Well, Zach, thank you so much for taking the time to come on the show and share your story. I really appreciate it.
Awesome, Alan. I appreciate being here. Can I put in one minor plug?
Oh, please do.
So, we talked a little bit about how things are going at Values Added Financial, and we looked under the hood a bit. And as you astutely pointed out, things are growing and we're going in a really good direction. And as we talked about, I really care about having enough time to be an engaged family member and be out and do good work in the community. So the only way to square those things was to close the door or to find some new teammates. So starting in the next few weeks, we're going to be hiring. So if folks are listening to this and they find the idea of being in a firm that's flexible and team-oriented and supportive and progressive exciting, I hope they'll reach out, because if they've gotten this far, it means they have a depth of curiosity about it.
It is so true.
And, I love mentoring and I love coaching, and I think it's a great opportunity and it's a great place to grow. So if anybody wants to come and be in DC and help progressives and grow up with the firm, we'd love to hear from them.
I love it. Your email's going to get blown up. So best of luck with the hiring process. And thanks again for coming on the show.
Awesome. Thanks so much, Alan. Have a great day. Thanks for having me.
NAPFA members, listen up. Supersize your NAPFA membership with all the perks from XY Planning Network. For starters, your annual NAPFA fee is covered by your XYPN membership. Plus, access XYPN's lead generation opportunities, including the popular Find an Advisor portal, blog syndication, national media request program, and more. Take advantage of free and discounted technology, an expert compliance team, E&O insurance, individualized coaching, and so much more. Visit xyplanningnetwork.com/supersize to download a special guide just for NAPFA members. Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future mailbag episodes with myself and Kitsis, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.